The Peter Schiff Show.
The U.S. stock market continues to be extremely volatile. And as I said many times on this podcast, I think the volatility coming after a long period of a record lack of volatility is a pretty good sign that the trend has changed, and that means the uptrend. And so there's a good chance that the bull market is now a bear market, although few people seem to realize that. We're still relatively close to the highs. In fact, the NASDAQ shrugged off the morning weakness and managed to gain for the fourth day in a row. I'm actually hearing a lot of people saying how, this tariffs or a trade war could benefit U.S. companies, give them an edge over the multinationals. All this is, wishful thinking, maybe trying to argue that there's some seats on the Titanic that are going to do better than others. Believe me, if the economy tanks and if the tariffs or a trade war simply weigh it down even faster, there's not going to be a place to hide in U.S. stocks. Even if you could find some stocks where you'll lose less than other stocks, it's a very, very weak argument to get on board. But meanwhile, the volatility started last night with the announcement of the resignation of Gary Cohn, who was the chief economic advisor to the president. And one of the reasons that his resignation spooked the market, the Dow futures initially tumbled about 400 points, was that he is opposed to the tariffs, at least vocally, so he would be against this type of agenda. And so the fact that he is leaving would lead people to believe that he's lost that argument internally at the White House, and so he's leaving because the president is pursuing a path to which he has objected. And so for people who have been hoping that maybe Cohen will rein in the president and that, he's just, talking and it's a lot of bark but not a lot of bite, the fact that Cohen is leaving got people to think, hey, maybe it is gonna be bite. And so that's why the market sold off. Now, by the time we opened up, the futures had moved off their lows. And for most of the day, the Dow traded between down maybe 100 and down a little over 300. But we had a rally near the end of the day. The Dow only closed down about 82. And as I said earlier, the NASDAQ finished positive again for the fourth day. Part of the news was that Trump is considering exempting Mexico and Canada from the tariffs. And that's supposedly good news, I guess, maybe because it lessens the probability that those countries will retaliate. But of course, a large portion of the deficits that he's concerned about in steel and aluminum, that's where the deficits are originating from. But the markets rallied on that. Obviously, the Canadian dollar, the Mexican peso rallied on that. In fact, if these rumors are true, and you never know, the president can change his mind from tweet to tweet, but if in fact the tariffs are enacted and Mexico and Canada are exempted, that is great news for Mexico and Canada. They're going to benefit from these tariffs. The U.S. economy will not, but the Mexican and Canadian economies will, because they will be able to sell more steel and aluminum to American consumers at even higher prices. And so they're going to benefit just like domestic steel companies will benefit, except the rest of Canada won't suffer the way America will from all the negative consequences of the tariffs in general, because Canadian consumers will still be able to buy steel or aluminum from wherever they want, and manufacturers in Canada may be able to enjoy lower prices than manufacturers in the United States, because manufacturers in Canada can shop the entire world for steel and aluminum, whereas American manufacturer will be limited to North America, and so there'll be less competition, and so there'll be higher prices. So this is more good news for Mexico and Canada than it would be for the United States, although I guess not subjecting Americans to tariffs if they purchase things from Mexico and Canada is better than subjecting them to those tariffs. So it would be less of a bad thing to the extent that the president does, authorize these exemptions. But, he's also talking about broader-based tariffs, particularly aimed at China, who could be particularly annoyed if Mexico and Canada are exempted from these tariffs, and that makes it look like it really is more aimed at China. If, when we were putting everybody in the same bucket, it was like, well, it's not just anti-China, we're just putting this in across the board. But if we pick and choose who the tariffs apply to, obviously we're going to piss off the people who we choose not to exempt, right? So maybe we endear ourselves a little bit more to China and Mexico, but we simply create more animosity between the United States and China. And I know, the president thinks we hold all the cards in the Chinese relationship, but they're holding all of our bonds, and they are holding a lot of dollars, and they are supplying Americans with a lot of products that they need at prices that are much lower than what they would pay absent the Chinese trade deficits and their willingness to finance them. Interestingly, I thought when I heard the news about Cohen resigning as the chief economic advisor, and of course Trump is immediately saying, oh, we're going to get somebody great, I'm going to appoint another economic advisor who's going to give me great advice. I mean, he wants a yes man, right? He doesn't want an economic advisor that's going to give him advice. He wants somebody that's going to rubber stamp his agenda. But, he has an entire council of economic advisors supposedly giving him advice. And people might think that this was always the case, that presidents were always getting the benefit of, a staff of economic advisors. That's not true. We didn't even have a council of economic advisors until 1946. The Second World War was over, and we created the economic advisors. I mean, maybe because the government had so much money because of the victory tax that they never repealed, they figured they'd blow some of it on a bunch of economists. But I think it's a complete waste. I mean, America made it to 1946 without any economic advisors. Well, and we had a much stronger economy, right? We went through the Industrial Revolution. We absorbed, tens of millions of immigrants, right, coming from all over the world. We had a massive expansion. We had a transformation from an agrarian to an industrial economy without any economic advice. Right? The president didn't talk to economists. There was no economists on the federal payroll. I mean, there was a secretary of the Treasury. I mean, he had that, but he wasn't there to give him economic advice. He was there to, kind of deal with the Treasury, the budget, right? Taxes, revenue, stuff like that. I mean, the economy ran itself. I mean, that was the whole idea. We don't want the government micromanaging the economy, so why do they need economists? What's the point? Right? This is not central planning. This isn't the Soviet Union, right? We want a free market. We don't want the government trying to figure out what the economy is going to do and then try to base policy on what they think is going to happen in the economy or what they think will help the economy. We want the government to be completely out of the economy. That's why there's no provision in the Constitution for any kind of economists. That's why it took so long before we were dumb enough to even hire any of these clowns. Now, I have no idea how many hundreds or thousands of people who have economists in their title work for the government, right? Not just for the president and his council of economic advisors, but we have all these agencies and departments that have all kinds of economists. Doing what? Doing absolutely nothing. We became the world's wealthiest creditor nation with no economists, zero economists. Now we've got all these economists, and it's a disaster. I mean, haven't any of these economists noticed, what a mess the U.S. economy is, how massively the U.S. economy has imploded, how we've gone from the biggest creditor to the biggest debtor? I mean, Trump wants to point to all these trade deficits, which are symptomatic of the problem. They're not the disease, they're the symptom, which is why tariffs, which are aimed at the symptom, are not going to cure the disease. But we developed all these deficits with all these economists giving us advice. I mean, didn't any of them notice these massive deficits and have any problem with it? Look, you've got this guy Cohen, he's resigning because of the tariffs. What about the budget deal? What about the tax cuts that are unfunded? What about raising government spending while you're reducing your tax revenue? Why not resign over that? That is reckless, irresponsible policy. So it's just over the tariffs. But all these economists have allowed the U.S. economy to implode. They haven't noticed all the warning signs as we have hollowed out our industry and have loaded the economy with debt, right, and consumption, and we've had this bloated government. In fact, that's really what the job of all these economists are. They are yes men. They are basically ministers of propaganda. They're not there to help the economy. They're there to justify government policy by trying to pretend that this is about helping the economy, or trying to pretend that some new program or some new regulation is going to make the economy better. This is all cover. This is all a smokescreen for government to get bigger and bigger and to reach into your pocket to buy votes, to sustain their own fiefdom within the government, to maintain their power base, and to keep government getting bigger. They hire these economists to justify what they want to do. But personally, I think that everybody who works for the federal government that has the word economist in their title should just be fired. We don't need them. It is a waste of money. None of these guys really understand economics anyway. They all went to some liberal school and they learned all this Keynesian nonsense. They're doing more harm than good, right? So just get rid of them. So the fact that this guy has resigned, Cohen has resigned, great. We don't need to appoint somebody to replace him. We should just basically ask for all the other resignations, or not just ask for the resignations. Let's just fire them. Hey, now speaking about trade, we got some trade numbers that came out today. Another record high. I mean, this is like a broken record, right? Every month we set a new record high in our trade deficit. So in January, we beat the record trade deficit that we set in February, which was a record, and we just revised February's number higher, and then we beat that too. Now, when I'm talking about a record, it's not a record total because it's only the biggest trade deficit in 9 years. The record is if you don't count energy. Just take out energy and focus on everything else. It's a record. Our biggest trade deficits were still when oil was close to $150 a barrel, and we didn't produce as much oil as we're producing now. But if you look at the core, we've never had trade deficits this big. So the January number, which was a record at the time, which was originally reported as 53.1 billion, is now revised up to 53.9 billion. And the January number, which was estimated to surge to 55.1 billion, actually swelled all the way to 56.6 billion for a new record. And it was this weak number that I think got the Atlanta Fed to downwardly revise their estimate again for Q1 GDP, which, by the way, last week, you remember it went down to 2.6? They took it all the way back up to 3.5. On what? I have no idea. Well, today they went back down, and now they're back down to 2.8. But had they not jumped it all the way back up to 3.5, who knows how much lower they'd be. But I don't know, where they got that big jump. But now they're coming back down to earth. But 2.8 is still a little bit above the 2.6. But I think that they're going to continue to notch it down. We keep getting more bad news. We got weak numbers yesterday on factory orders, down again, or down 1.4%, a little bit more than the 1.3%. But I think it's the weakest in 6 months on factory orders. I think that's going to continue to go down. We got the numbers also today on productivity and costs. Productivity in the fourth quarter, they did revise it up slightly from minus 0.1 to flat. But no growth in productivity is very problematic. Unit labor costs were up 2.5%, which is one of the reasons that productivity is down. But year over year, labor costs are actually up by their slowest pace since 2010. And I keep hearing the president, talking about how wages are surging, but there really isn't any evidence that that's happening. But that is the narrative. I was watching today on CNBC, Anthony Scaramucci came on. Remember him? He was from Skybridge. He runs the SALT conference that I've spoken at a few times, and I actually like Anthony. I think he's a nice guy. I mean, I consider him, sort of a friend. I mean, it's not like we pal around, but we have a friendly relationship with one another. But he was on television today, basically shilling for the president, talking about how great the economy is under the president, how much better it was under Trump, and he's talking about how the economy has been growing at 3%. And he said Obama only had 1 quarter of 3% GDP growth during his entire 8 years. And I'm like, what people just talk. I sent him a text and I'm like, Anthony, he had 5 quarters of more than 3% just in his second term. And he had 3 of them that were over 4% and 1 of them that was over 5%. So the economy is not growing much faster under Trump than it was under Obama. Obama's average for his second 4 years, 2.2. Trump, GDP year 1, 2.3. It's basically the same thing. It's a rounding error. And we'll see what happens in 2018. I think the economy is in a lot of trouble in 2018. But all this talk about how great everything is and what a great job the president has already done, this is counterproductive. He hasn't done a great job. Has he cut some regulations? Yes, but not nearly enough. I mean, we still have way more regulations than we had a few years ago, even though he's cut back some of them. I mean, we barely made a dent in the regulations that were piled on under Obama. And remember, Bush piled them on too. I mean, so we barely scratched the surface in rolling back regulations. Yes, he cut taxes, but big deal, he increased government spending at the same time. So the tax cuts are a fraud, right? I've said this many times. It's not tax cuts that stimulate the economy, it's shrinking the government. Yes, part of the problem with big government is that you got to pay for it. And you have to pay for it with taxes, which hurt the economy, which hurt economic growth. So if you shrink government, then you can cut taxes and you get more economic growth. But if you just cut taxes and don't shrink government, or worse, you do what the Republicans and Trump did, you increase government spending while you're cutting taxes, then the deficits blow out of control. And the most expensive way to pay for government and the most economically damaging way to pay for government is by borrowing the money instead of taxing it. And ultimately, it ends up printing the money because you can't borrow it all. So you end up substituting taxation for inflation. And this is worse. And ultimately, all of the borrowed money needs to be repaid with interest. So it's just like putting government on a credit card. And I'm not going to give Trump credit for that. That's not a good thing. You know, speaking about credit, we did get the consumer credit numbers that came out today. And we had a much smaller increase in the amount of debt that consumers took on. In fact, they revised higher the splurge in December, right? Initially, they said they took on 18.4 billion, and it's now we know they took on 19.2 billion. But a huge drop in January. They were supposed to borrow 17.4, and they only borrowed 13.9. Now, that's still more borrowing, right? So you're still talking about a drowning man, going further, under the water, right? But the key is that the U.S. consumer who's tapped out is going deeper into debt at a slower pace. Now, I guess that is a good thing, right? But the fact that we're still going even deeper into debt is a problem in the long run. It's like, the first rule of holes is that when you're in one, stop digging. So the U.S. consumer is already digging his hole deeper by borrowing even more money. But again, I think a lot of people think, who cares how much debt I have now? I can't pay it back anyway, so I might as well go out with a bang, right? If I'm going to go bankrupt eventually, I might as well go bankrupt owing even more money. So you have that, moral hazard out there. But the fact that consumers are slowing down their borrowing, if you're relying on consumer spending for GDP growth, if you're relying on consumer spending for corporate earning growth, you ain't going to get it. Because the consumer can't spend what he can't borrow because we know they're not earning it. Earnings are not there. We know that consumers have no savings to tap into because savings are at a 10-year low. So the only way they're going to buy more is if they can borrow more. Well, obviously, if the rate of borrowing is going down, then that is going to bode ill for future short-term GDP, which everybody is counting on to pad corporate earnings and to diminish the deficits that are being produced by the tax cuts and the higher government spending. Remember, they're counting on extra growth to bail them out. Well, if the consumer can't borrow to spend, you're not going to get the extra spending that is going to, that powers 70% of the GDP. Now, we also got some stronger than expected jobs news out of the ADP, and this is the first look. We get the official non-farm payroll on Friday by the government, but this is the private sector payroll numbers. They were looking for 205,000 new jobs. We got 235,000, so a 30,000 beat. And they also revised last month's 234 to 244, so 40,000 beat over the 2 months. And so that was looked at as stronger economic data. It initially did not weigh down the bond market because I think the bond market was being supported by the weakness in the stock market. But yields ended up higher on the day as the stocks recovered their losses. Yield on the 30-year only up slightly, just above 3.15, and the 10-year hanging out at 2.883. But if you look at these charts, to me, we are just basing for another explosive move up in yield and down in bond prices. And For some reason, a lot of the tariff talk is getting people nervous, and so that's producing a bit of a bid in the bond market. But the bond market ain't rallying; it's just not collapsing. But I think ultimately what's happening is bearish for bonds, and bonds were in a downtrend anyway, right? But the growth is slowing, inflation is picking up, the deficits are exploding. I mean, this bigger than expected trade deficit again today does nothing. The dollar didn't go down today; it was actually up slightly. Gold was down about $9. Now I think it was up 14 or $15 yesterday. But I mean, gold is not reacting the way it should. The dollar is not reacting the way it should to these huge trade deficits. In fact, nothing is really acting the way it should. The stock market is very resilient in the face of all this bad news. I mean, to me, it just shows how few people out there understand just how bad this news is, understand the threat. Now, look, maybe Trump is just making a bunch of noise. Maybe he's creating a negative situation, right? And then he won't do anything. And then maybe the markets will rally, right? If you can scare the markets and get them all nervous about these tariffs and then not even impose them, all of a sudden it's like, oh, this is great news, right? Because we didn't get this bad stuff that we thought we were going to get. And now you can manufacture some good news that the market can rally on. It's like I threatened to hurt you, but then I decided not to do it. And so now you can enjoy the fact that you're not going to get the pain that I was potentially going to inflict on you. I mean, maybe that's part of the strategy. I don't know. I mean, in fact, that's what Scaramucci was kind of talking about. Like, well, the president doesn't really mean that he's going to put these tariffs. He's just using it as a bargaining chip to get better deals. But again, better deals is not what we need. Bad deals are not why we don't have deficits. Look, you can look at a lot of countries that have trade surpluses with countries with which we have deficits. I mean, what's the reason for that? It's not that, they've got much better deals than we do. The problem is we're not saving. We're not investing in plant and equipment. We're not training the workers. We don't have the money to do that because we're blowing it all on consumption. We got interest rates so low that nobody is saving, and we have too much regulation. We have too many taxes. I mean, we got all sorts of ways that we are undermining our American businesses, which are the reason that we are running these trade deficits. And those are the things that we need to focus on, not trying to focus on the symptom and trying to hide the symptom with some kind of tariff. I mean, there's still a lot of people out there that are actually thinking that somehow there's going to be some success in this strategy, right? That there's some kind of method to the madness, when in fact it's all madness, because none of it is going to work and none of it addresses any of the underlying economic problems that have produced this trade deficit. Now, we'll see what happens. We get some more economic data tomorrow, and then we get the big number on Friday, the non-farm payroll number. I have been waiting for these numbers to really weaken. Thus far, that hasn't happened. It's only a question of time before the jobs numbers really start to turn around. How much more time is anybody's guess, but I would imagine that sometime before the elections in September, we're going to see a turn. I mean, everything else seems to be turning. And, higher consumer prices, higher interest rates, look at what's happening in the housing market, look at all the signs of economic weakness. Eventually, it's got to show up in the employment numbers. They are usually a lagging indicator, right? So usually employment could roll over later than a lot of the other data, which has already rolled over. Nobody wants to acknowledge it. Nobody wants to accept it. Everybody wants to run with that false narrative of how horrible things were under Obama and how great things are now under Trump. And I agree with half of that. Things were horrible under Obama. It's just that they're just as horrible now, if not worse. The problems we had under Obama are actually bigger than they were then. It's just that we're not focusing on it because we got some tax cuts. And now we have all this excitement, all this misplaced optimism that things are going to get better. But what people don't understand is they're going to get worse, which is, why when I see guys like Scaramucci talking about how great the president's plans are and how wonderful everything is, and it makes me cringe, because I know how this is going to blow up in the face of all Republicans and anybody who advocates for less government, lower taxes, less regulation, because they are promising so much and will deliver so little. And again, these guys, they think all you have to do is cut taxes and everything is going to be great. No, it's not. But if you say that, then you basically dilute the entire message. The message of tax cuts is we need smaller government. See, if you don't do that, right, you have to let people know that it's a trade-off. You can't just have tax cuts for free. What the Republicans have to sell is less government. The reward for less government is the tax cuts. See, if they do that, it will work. But if they just say, let's cut taxes and then bad things happen, then you undermine the case for tax cuts. We still want lower taxes. We just need less government so we can have them, right? We need to make government cheaper so that we don't have to spend all this money paying for it. That has to be the Republican message. Unfortunately, it's not. And so they are going to tarnish all of the benefits that you can have from tax cuts if they go hand in hand with less government. And they're going to use the economic disaster, the left is, to blame everything on the tax cuts. And therefore, the solution is higher taxes, right? Tax cuts cause the problem, so higher taxes will solve the problem, right? We need to raise taxes on the rich. We need to raise taxes on corporations. Oh, and by the way, we're going to keep making government even bigger. So we are setting ourselves up for a big disaster. Hey, talking about disasters, I don't want to finish up this podcast without talking a little bit about Bitcoin. Bitcoin has also seen some increased volatility recently. In fact, earlier today, it was back below 10,000. Bitcoin had risen almost up to 12,000. I don't think it quite got there. I did see it in the high 11,000s. Maybe it got to 12,000 when I wasn't looking. I don't know. But earlier today, it got below 9,500. So another pretty big drop. I mean, as I'm speaking, we've recovered the 10,000 milestone. But I still think technically the market's going lower. I mean, forget about my long-term fundamental outlook, which is way lower. Just in the short run, the technicals still look very weak. And remember, the bottom was about 6,000. I think we need to test that. Even if Bitcoin is going higher, even if it's going to go back to 20,000, I think it needs to go back to 6,000 first. So we'll see. But of course, if it gets down to 6,000, there's no guarantee it's going to have a double bottom. It could just go through that low like a hot knife through butter. Then where's the next support? 5,000, 4,000, 2,000, 1,000? I don't know. But there is a lot of risk there in this market. I mean, I look at the cryptos as risk assets, just like any other risk asset. I don't look at it like a safe haven asset like gold, even though they want to describe it as digital gold. It has nothing in common with gold. And if you look at the way gold has been trading, I mean, gold has not been very volatile. I mean, even if you see today down $9, up 14 the other day, those are big moves for gold, but those are tiny moves. They're not even 1% moves, really. Or yesterday's move was just over 1%. But Bitcoin, moves 1% an hour. I mean, it was down over 10% intraday when it was down near the lows. So this is big volatility. And again, a lot of the Bitcoin proponents keep saying that the volatility is going to go away. When? I mean, it's been, they think, well, maybe if the price gets high enough. But the price is certainly a lot higher now than it was 4 or 5 years ago. Yet it's certainly just as volatile with these massive swings. There's certainly no stability here. Anybody that is betting on stability is betting on the come. They're betting on something where there's absolutely no proof that it's actually going to happen because there's no proof that it is happening. So it's all wishful thinking at best. And of course, for some people, it's just not wishful thinking. It's just stuff that they're saying because they're trying to justify the mania or they're trying to get other people to buy, whatever. But we'll see what happens in the crypto market, in the stock market. I mean, there's a lot of potential breakdowns, a lot of air coming out of a lot of bubbles. The mother of all bubbles, of course, being in the U.S. bond market and the U.S. dollar. And remember, all U.S. bonds are dollars, right? They're dollars that pay interest, right? They're dollars with a coupon. But you can't even spend them now because you can't really spend your treasury until you sell it. So if you got a 30-year treasury, if you want to convert that into liquidity, you got to sell it. And if interest rates go up, even though let's say you have a treasury that's going to pay you $1,000 in 30 years, if you had to sell it right now and rates spiked up, you might only get $500 for it, not the full 1,000, right? Bonds could go to a huge discount if interest rates go up. Now, if you have a short-term bond, if you have like a 90-day bill, well, that's almost exactly like cash, right? Because you can get your money in 90 days. And even if you have to sell it before maturity, I mean, you're not going to take much of a haircut because the person who buys it from you only has to wait a short period of time to get all the money back. So that's almost exactly like a dollar. So the dollar bubble and the bond bubble are pretty much one and the same. They're all part of the overvalued dollar and the massive amount of money we were able to borrow to finance all these trade deficits. That's what Trump doesn't seem to understand when he keeps talking about how we're losing on trade and how all we have to do with a country that we have a trade deficit is stop trading and we win. We don't win. We lose. Our trading partners are losing now. We do them a favor by not borrowing more of their money to take some of their products that they could have used themselves and giving them IOUs that are no good, bum checks that if they ever tried to cash them, they would bounce, right? I mean, if you're buying stuff from a store, right, and you've conned the store to accepting your checks, even though you've got no money in your checking account, and you keep shopping at that store and you keep giving them a check, and the guy just, sets it in a drawer somewhere and just assumes you're good for it and never bothers to try to take him to the bank. I mean, who's the winner and who's the loser? Who's the sucker, right? And who is going to lose if you can't go to that store anymore, right? Not the store owner, because he's going to win, because he's going to stop losing his merchandise in exchange for a bunch of checks that would bounce if he ever tries to cash them. You're the loser because now you don't know another store that's dumb enough to take your worthless checks, right? If you want to get more merchandise, you might actually have to go out and get a job and pay for it. That is the rude awakening that all this saber rattling on trade, right? And of course, long term, Trump is right in that the sooner we stop running these deficits, the better, right? We've got to start producing again because eventually foreigners are going to cut us off anyway. It's only a matter of time. And to the extent that we can accelerate the day of reckoning, it's actually a good thing in that we can start the healing process sooner. But what Trump doesn't understand is how painful it's going to be in the short run, right? Because now the economy implodes, our standard of living implodes. We have to deal with reality. We just can't keep borrowing to live beyond our means. The ride on the global gravy train comes to an end. And now we got to start building back a viable economy. And the American electorate, the voters, the people on welfare and living off of the government, nobody is prepared for that reality.